This one thing always happens right before a depression, and it appears that we are once again right on the edge of what could be a financial catastrophe. And that one thing is clearly significant abundance, because when things get really, really good, it seems like the next step is for them to get really, really bad. And more specifically, it is significant abundance that comes along with a significant amount of debt in order to fund that abundance. And if you haven't been paying attention, that's pretty much what is happening right now in the world economy, especially in North America. But the question is that really something that is going to lead to a Great Depression? And in order to understand that, we need to understand what actually led to the Great Depression and what the parallels are then to now. And yes, there are some risks in the current economy, but there are also some safe stops that have been put into place that will very much prevent us from hopefully finding ourselves in the next Great Depression. And in this video, I'm going to talk about all of the things that led up to the Great Depression, which, by the way, is a very hotly contested topic, but there are seemingly compounding effects and a couple of things that the Fed did wrong that hopefully will never happen again. And then I'm going to talk about what the current risks are in today's economy, as well as what you can do to protect yourself in the event that we do find ourselves in the next Great Depression. And all I ask in return for all of this information is that if you enjoy it at the end, just hit that subscribe button and hit the like button so more people like you can see this video. And if you're not familiar with me, by the way, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So let's get started and talk about the things that led to the Great Depression. And while some people believe that it was the stock market crash or tariffs, or deflation and unemployment, or bank failures, the reality is that it was several things compounded on top of each other, and most specifically inaction by the Fed. For the most part, economists don't agree what the one single cause was, and in fact, it looks like it wasn't one single cause, but most agree that not enough was done to prevent the situation that was unfolding right in front of the eyes of the Federal Reserve. And many people suggest that they were very much asleep at the wheel. And I'm going to get into that a little bit later on in the video, right before we talk about what you can do to protect yourself in the event that the Fed once again finds himself asleep at the wheel. But let's start by unpacking the individual things that happened in the economy that led to the Great Depression. And let's start first by talking about the stock market crash. So leading up to the stock market crash of 1929 and basically 1929 to 1932, because there was actually multiple crashes and a period of prosperity, which I'll show you in a second. But very much the biggest problem associated with this was the Roaring '20s and the use of leverage to buy stocks. This was a period of time where everyone saw the stock market as a new place where they could make a significant amount of money. And people were making so much money that they saw the opportunity to borrow money and invest in the stock market at pretty much zero risk. And of course, investing in the stock market is never a zero risk proposition. So what happened is you had general consumers borrowing beyond their means in order to invest so that they had money that was coming in from basically investing wealth. It was a get-rich-quick scheme that was en masse. Everyone believed that you could make a ton of money in the market, so everyone jumped in. This is similar to what happened leading up to the dot-com bubble bust in the early 2000s, where everyone saw tech as a place that if you invested, you couldn't lose. And of course, everyone found out that they could lose, and they could lose big. And this is what happened in the 1920s. And basically between 1929 and 1932, if you had been invested in the market, you would have lost up to 90% of the value of your stocks. Now, this is particularly problematic, especially if you had borrowed money to invest. So let's say you'd borrowed $10,000 and you lost $9,000. Well, now you had a $10,000 loan that you had to pay and only $1,000 worth of equity left, which meant that you had a pretty large debt and definitely not enough money to pay for it. And then that combined with what happened next, which was deflation and unemployment, which I'll get to in a second, compounded the whole thing and made it so that you were pretty much going to go bankrupt. And this stock market crash did destroy massive amounts of wealth. And it also destroyed spending in the economy, because when people had less money and had these massive debts, obviously they weren't spending on things like the brand new Ford Model T or the brand new refrigerators that were all the rage. And on top of that, all this bad lending, all this money that banks had led to consumers in order to invest that they can no longer repay, also led to a significant amount of bank failures, which we'll get to in a second as well. And all of this, yes, definitely was bad, but it wasn't enough alone to cause the Great Depression. Yes, there was a significant amount of wealth lost, but a stock market crash is something that ultimately can be recovered from if all else is equal. But in this case, not all else was equal, because there was compounding effects on top of the stock market crash. Now, just as a frame of reference, this is what that stock market crash looked like. You can see the peak in 1929 and the significant drop that happened. I believe they called this Black Tuesday. Then there was a little bit of a rally, which if nothing else had happened, everything would have been fine. And you saw the market come back a little bit here. And then you saw a significantly greater crash because of everything else I'm about to talk about. Now, the next thing that created a pretty significant issue was the tariffs, specifically the Smoot-Hawley tariffs, which were essentially tariffs that were designed to protect farmers and manufacturers in the US. Because at the time, what was happening was a lot of goods were starting to be brought in from overseas. And US manufacturers and US farmers saw this as a potential threat to their businesses and lobbied the government to put these into place. And at the time, when these tariffs were put into place, there was significant kickback from economists. In fact, there were over 200 economists that signed a letter to the federal government stating that this was a bad idea. And of course, it very much became a bad idea because the thing that happens when you implement tariffs is other countries retaliate and implement tariffs of their own. Now, in the grand scheme of things, these tariffs led to world trade collapsing by 2/3. So in other words, because of all the tariffs, there was 2/3 less global trade, which is a significant problem. But it wasn't as big of a problem in the US because the US at the time was what was considered a closed economy. They didn't really do a ton of trading relative to other countries and relative to the amount of things that they produced at home. So the US economy only shrank by 1/3. So the tariffs, while they were a contributing factor, were not a factor that actually caused the Great Depression. The tariffs combined with the stock market crash, of course, didn't help, but they weren't, in fact, the cause. And this brings us to deflation. And this is where the real story begins, because deflation was, in fact, the single biggest compounding effect that caused all of the problems that came after it, which were the bank runs and the Fed being asleep at the wheel. And here was the real problem, is in the absence of deflation, there wouldn't have been reduced prices for things like those Model Ts and those refrigerators that were all the rage. And without reduced prices, companies wouldn't have necessarily needed to have layoffs, and they also wouldn't have had to cut wages at the rate that they did. If prices don't fall and people are still buying, there's no need to cut. But of course, deflation was significant and therefore everything was going down in value, which meant there was less money to basically be used throughout the economy. And specifically, this had an impact on businesses that couldn't afford to pay their employees anymore, which caused a pretty big problem. Now, on top of that, there's this thing that people don't often see, and that is the relationship between deflation, inflation, and interest rates. And what happens in a deflationary environment is you have prices that are going down, and even though interest rates may be low, or in this case, they were pretty much zero, when you have deflation and you have less money available to pay debts, what actually happens is you have real interest rates that increase. So even though the interest rate on your loan may have been 2%, the deflation that happened made the real interest rate higher because you were having less and less money every single month in order to pay back those loans. And if the value of your money is lower and lower, well, that increases the borrowing cost for that loan that you took out a year or two ago at a super low interest rate, because the value of the dollars you're using to repay the loan is essentially the same as effectively having a higher interest rate. And this is why modern economies are so concerned with price stability. That 2% inflation target is there for a reason. One, so that inflation doesn't get too high and things don't get too expensive too fast, but two, so that we don't find ourselves in deflationary periods where our dollars are worth less and subsequently the cost for pretty much everything goes up, including the real interest rates of our loans. Now, when you have this significant deflation that we saw in the 1920s and early 1930s, that leads to unemployment. And unemployment in the 1930s got as high as 25%, which means 1 in 4 people were without a job. And there were some problems here, some compounding problems, including Hoover asking companies to keep wages high, which of course was unsustainable. It's arguable that his request for companies to keep wages high didn't actually work at all. But even if companies were to keep wages high, if they didn't have the money available because of the lowering value of their goods, that led to job cuts. And it's arguable that this request to keep wages high actually led to higher unemployment. And of course, unemployment leads to significantly greater problems, especially when people are trying to pay back all that debt that they accumulated when they were investing and lost all their money and now had to pay back those loans, which they didn't have the money for. So this led us to the next step of the whole problem, and this is where it gets really severe, which was the bank failures. There were 7,000 bank failures during the Great Depression. Now, these were mostly regional banks, and I'll get to the problem with that in a second when we talk about the Fed being asleep at the wheel. And obviously, those bank failures led to bank runs. And if your neighbor's bank failed and they lost half of their wealth pretty much overnight because the money just vanished when that bank went out of business, well, that would cause you to go, hey, I don't want my money to be in my bank account because I'm afraid my bank's going to fail, which led to more and more people going to their banks and trying to get the money out. Now, here's the problem with that, is that because of fractional banking, banks typically don't have the reserves necessary to pay out all of the people who have deposits with them. So if everyone goes into a bank and asks for their money back, well, that's going to be problematic purely from the sense of they can't pay everyone back. And when they can't pay everyone back, well, guess what? The bank fails. And subsequently, when you get all of these bank failures, that means you have less banks. And if you have less banks, you have less companies that are available to create lending. And when you have less lending, that leads to a contraction of the money supply. In fact, the Fed doesn't have to contract the money supply in order to contract the money supply. Literally, if you have banks that stop lending, that is effectively a reduction in the money supply in itself. That's just because of the way the fractional banking system works. And here's the big problem is when the money supply contracts and contracts at the rate that it did during that deflationary period, well, that leads to a decline in spending, it leads to a decline in investing, and it leads to a decline in gross domestic product. And all of those things are obviously problematic for an economy. But there was one other major issue with bank failures as well, and that was because the Great Depression was pre-credit bureaus. And at the time, in order to borrow money, you basically had to have a relationship with your bank. You would go into your bank, you would say, hey, I've never borrowed money from you, but I've got all of these deposits. I've been dealing with you for a while. Can I get a little bit of money? And they'd, of course, say, yes, Mr. Farmer, you can get a little bit of money. We trust that you'll pay it back. And if you do pay it back, we will eventually at least be open to lending you more money. And that was how credit was created back then. It was the continued relationship with your banker and the proven ability to pay back gradually larger and larger loans. When they knew you were good for it because you had a history with them, well, they would lend you more. And when banks failed, you lost the relationship with your bank, and subsequently lending dried up almost to zero because you couldn't just go to your brand new bank and say, hey, I'm good for it. They needed to go through that same process of getting to know you. And those were often relationships that took decades to create. So all of the bank failures and the subsequent collapse of lending reduced the money supply, and that led to even greater problems. Combined with deflation, combined with the stock market crash, you can start to see how all of these things were compounding. But here's where it gets really, really interesting, because the one thing that really caused all of these compounding effects to get even worse was the fact that the Fed was asleep at the wheel. Now, the Fed had been created about 15 years prior to the Great Depression to create stability in the banking system and basically confidence in the economic system that was the United States. And while that was their mandate, they very much believed at the time that the only tool they had in the toolbox was essentially interest rates. And since interest rates were already at zero, they had pretty much put up their hands and said, hey, we've done everything we can, and we're just going to have to let this play out. And that was a mistake. And in addition to that, there were other mistakes because the Federal Reserve was only mandated to backstop national banks. Most of the 7,000 banks that failed were regional banks. They were banks that had state charters, not federal charters, and therefore they were not protected by the Federal Reserve. And even though this thing called the Federal Reserve existed, which was there to lend to banks, if you were a non-member bank or a state chartered bank, you actually didn't have the ability to borrow from the Federal Reserve, which meant that if there was a run on the bank, you didn't have that fail-safe to be able to go to the Federal Reserve and save yourself. In addition to that, national banks didn't want to go to the Federal Reserve to borrow either because they were afraid that that would be negative news and it could actually lead to a run on the bank. And the one thing that the Fed really wasn't paying attention to was the fact that the falling prices, the deflation, was actually creating higher real interest rates. Because even though interest rates were zero, the real interest rates were going up because of the deflation, which was previously discussed. And here's the reality, is the Fed should have backstopped all banks. Had they done this, had they had the tools in place to backstop those banks so that they didn't fail and fail en masse, the Great Depression probably wouldn't have been as great or as awful as it ended up being. And that leads us to today, because what's the difference today versus back then? Well, very much when Lehman Brothers failed in 2007 and 2008, it could have been another Great Depression all over again, but it wasn't. And the question's why? Well, it's because of all the lessons that were learned from the Great Depression, and specifically the things that were put in place to prevent that sort of disaster from ever happening again. For example, today the Federal Reserve is now responsible for all banks, and if a small regional bank starts to fail, as we saw in the last couple of years here, they will step in to save it, either by having it bought by another bank or by lending it funds if it deems that it is actually savable. In addition to that, there's also FDIC insurance, which is designed to prevent the possibility of a bank run, because if you have $250,000 per institution, basically guaranteed by the federal government, well, the likelihood of you running to your bank to try to get your $250,000 out is greatly reduced. And that's not to say that that won't happen, but for the most part, that FDIC insurance is designed to make you feel safer, which should prevent people en masse from running to the bank and trying to pull out every single penny that they have, even though there are people that are scared right now and are doing that. But the main difference being today that when one person does it, not everyone does it, because there's a lot more confidence in the banking system and that your money is protected today. And last but not least is the invention of credit bureaus, which now allows you to go into pretty much any lender. They don't need to have a relationship necessarily, although it can help because they can see your track record for paying your bills, which makes lending more free and creates more liquidity in the market. So all of these things combined are kind of the things that make it less likely that we'll see a Great Depression that is as severe as the one that we saw in the 1930s. Now, that being said, there are some risks, because obviously there is always the great unknown. There's also the theory that there could be a collapse of confidence in the US dollar, which is a very real thing. However, there's also the clear evidence that there's a lack of confidence in any other dollar or any other currency that would potentially replace it. I mean, if you look at the euro, which was designed back in the 1990s to eventually be the replacement for the US dollar as a world currency, well, what you saw is that when you put a whole bunch of countries together and suggest that they agree on one currency, it's not always an easy path forward. In fact, it's very much an uphill battle, which is why the euro never became a reserve currency in any way, shape, or form. And then compare this to the BRICS nations, which, by the way, are some of the most unstable nations on the planet. And the chances of them all agreeing on which country's currency is going to be the new reserve currency are pretty much slim to none. I mean, India and China can't even agree on their own border. Are they really going to agree to trade in each other's currency? Which is why you see them purchasing gold, because gold is becoming the de facto way for those countries to trade, because they won't accept each other's currencies. And really what it would likely take for a new reserve currency to emerge is a conflict like World War II, where there was clearly a victor, and a victor that basically got to make the rules and say, hey, we're now the new reserve currency, which hopefully that never actually happens. And the biggest risk is the potential for a lack of intervention. So in other words, the Fed just throwing up their hands, or the government just throwing up their hands and saying, let's just let the market work, and basically doing nothing when there starts to be a problem. And what we've learned over the last 10 to 15 years is that governments are now very much conscious of not letting the worst case scenario happen, which is why the financial crisis of 2008 didn't turn into the next Great Depression. Yes, it was bad, but it was nowhere near as bad as the Depression. But here's the thing, we don't have any control over any of this. So even if there is a currency collapse, even if there is potentially a next Great Depression, the reality is that you can't control it and I can't control it. The only thing that we can control is the things that we can control, the things that we do personally. So instead of worrying about whether or not there's going to be a next Great Depression, which there might be, but there also might not be, what we need to worry about is what we can do to de-risk ourselves so that we aren't in a situation where if things get bad, we're one of the select few that it gets really, really bad for. And there's several ways that you can do this. So how to protect yourself in the event of the next Great Depression is to A, deleverage, B, increase your income, and C, strategically accumulate your assets. So let's start with deleveraging. Now, there's two ways that you can deleverage. The first, and this is the ideal, is to reduce debt completely. Get it to zero. Get rid of your mortgage, get rid of everything. And if you can do that, the impact of a depression on you personally will be small. Because if you have no risk, if you have no leverage, nobody can take your home, and every single penny that you have or that you are able to earn, even in a depressionary scenario, will be there for you to buy the essentials and to be able to continue to live. Now, obviously, a lot of us have really big mortgages, and that may not be the ideal situation. So, if you can't reduce debt completely down to zero, then the next best step is to reduce your monthly obligations. This is done by eliminating your credit cards, eliminating your unsecured lines of credit, and then potentially going and taking a look at your mortgage scenario and seeing if you can reduce your payments so that you are able to eventually start accumulating assets that will potentially be there to backstop you in the event of a job loss or something else. So once you've gone through and you've started deleveraging and reducing your monthly obligations, and by the way, the most important thing here is to reduce the monthly obligations that you have to other people and other companies. That is what reduces your risk almost in its entirety. But the next step is to increase your income. And there's several ways you can do that. The third one I think is the most important. The first is to seek better employment. So always make yourself as marketable as possible and always be on the lookout for better opportunities. And one of the best ways you can do this is by investing in yourself, investing in your knowledge, and doing everything that you can to make yourself more marketable on the job market. That means constantly improving and having a growth mindset. Then the next step is once you do have that better job or that better income, and sometimes better income can come from your existing company by working really hard and getting promotions, but you want to make yourself indispensable. You want to be the person that shows up first, the person that leaves the latest, and the person that drives the greatest amount of income to the bottom line. Because if you can be that person that is indispensable, the chances of you losing your job become less and less. And in addition to that, I also believe in the era of side hustles, there is the potential to diversify your income by having little things, little projects, hobbies that you like to do that will potentially make you some money on the side, but don't make you so tied to your existing job. And I genuinely believe that most people in this day and age should be using their hobbies to make more income because this is the easiest time in history to build significant wealth by doing things that aren't necessarily your job. In fact, I have a friend who makes almost $250,000 a month on a YouTube channel. He is a teacher by trade, and he teaches math on YouTube and makes a significant amount of money. And he did this simply by diversifying his income from just his teaching job to teaching on YouTube. And now his channel gets millions and millions of views every single month because he is an exceptional teacher who is teaching students who aren't his own how to do things like basic math skills like calculus and all the other stuff that teachers actually have a really hard time of teaching properly. And if you can diversify your income source and find ways to make additional money in addition to your job, well, in the event that you do lose your job, you've always got an additional stream of income, which is hugely important. They say diversify your assets. Well, I also am a big believer these days in also diversifying your income. And then last but not least, the next thing you want to do is strategically accumulate assets. And diversification is key here. What that means is making sure that you are investing in balanced portfolios. You aren't sticking all of your money in the stock market because if it loses 90% like it did in the 1930s, well, that could be catastrophic. But having a well-balanced portfolio like the Ray Dalio all-weather portfolio or a 60-40 split between stocks and bonds will allow you to have the protection of things like the bonds and the potential upside of the stocks. But make sure that your investments are diversified. And in addition to that, maybe it isn't all in the markets. Maybe you're investing in real estate as long as you're not applying too much leverage. But basically what you want to be doing is investing in assets that produce an income, something that shoots off money every single month, dividend stocks, bonds that pay on a monthly basis interest, and real estate that will pay you more and more cash flow over time. And you want to prioritize asset accumulation over consumption. And the goal is to have your asset accumulation exceed your consumption. So in other words, if your monthly cost of living is $2,000 or $3,000, the goal is to be spending $4,000 or $5,000 accumulating assets every single month. And the way that you do that is by keeping your baseline low. So when you get that raise or when you get newfound money, you don't go and spend it, you don't increase your lifestyle, you keep your baseline where it's at, and you start using that money to accumulate more and more assets. And the long-term goal here is to eventually have those assets become your primary source of income. And if you can do that, where you have assets that are kicking off more income than your actual job is, well, that's when you have real financial freedom. And even if some of these assets take a hit during a recessionary period, well, that is an opportunity to continue buying those assets at lower and lower values. And if you're positioned correctly, a Great Recession, a Great Depression, or any of the things that we just talked about that led up to the Great Depression should have a minimal impact on your personal economy. So to round this all out, control what you can control, and that is mostly your debt, your income, and the assets that you buy. And if you want to see more information on this, including a really good video on whether you should pay off your mortgage or invest, and I think this video makes it pretty clear that you should probably be paying off your mortgage before you borrow money to invest, make sure you check out this video right here.